Welcome back to the Prepared Mind channel. I'm John. I'm the host, and I've got a very special guest today. It is Craig Hemke from tfmetalsreport.com. Craig is a very interesting character. I've followed him for quite some time. Thank you for coming on, Craig.
John, it's a pleasure. It's wonderful to make your acquaintance, and I'm thrilled to be on your site because I think you've got a great service. You're really trying to help people out, and I'm glad to help any way I can.
Oh, that is terrific. I've listened to you largely from day to day on TF Metals Report. You talk about gold, silver, economics, some of the political decisions, but I've heard you in other interviews scan far and wide across the spectrum, social, political, military, industrial complex, all kinds of crazy stuff. So I'm really proud to have you on the show because I think you can take us in some interesting directions, help the Prepared Mind crowd understand some more deep concepts. So, let's dig into it a little bit, and I'll turn you loose. If you've got some stuff you want to run with, let's do it. But this week, we've had some interesting things happen in precious metals. Let's start there and then branch out, Craig. What is going on? We had the metals run up, and then what's happening, and why is it important?
Well, first, thank you for all those kind words. I appreciate it. And to that point, if you follow the precious metals, you quickly find out you've got to kind of be an expert in everything. I've got a guy that I guess I consider a friend or an acquaintance who has a national radio show named John Batchelor. And he told me once, as a gold bug, which is, a term I'll gladly wear, you've got to kind of be an expert in everything because gold as universal money, right? Everybody's got their own fiat currency from nation to nation or as a block in the euro, but gold is respected planet-wise as money, as a store of wealth, and has been, frankly, for millennia. And so that means you can't just focus on what's going on in your neighborhood or your state or your country. If you're going to follow gold, you got to follow everything. So that's what we try to do. And so I kind of forced into doing it. And thankfully, because my site has a small subscription fee and I've got advertisers, it's a full-time job, which these people, the members of my site, basically I'm their eyes and ears. They're out there every day worrying about making a mortgage payment and caring for their parents and putting their kids through college and all that kind of stuff. My job seems like 14 hours a day, is to watch the headlines, watch prices, watch all of the different markets, watch what's going on economically, all this stuff, and report back for people. And so that then makes me have to keep track of all this stuff and have an opinion. You know what they say about opinions, right?
Everyone's got one and they all stink.
Yeah. Opinions are like a body part in a way, right? Yeah.
Armpits and assholes, Craig.
That's right. Anyway, what's going on specifically in the precious metals is something we've been on. Well, I've been talking about this now since 14 or 15. Mm-hmm. The Fed sold us this bill of goods back 10 years ago when the banks essentially failed. And I've got a friend of mine by the name of John Titus, who would be a good guy for you to get to know, John, who has produced some wonderful videos. His YouTube channel is called Best Evidence. He doesn't have ads or anything. He just does it out of the goodness of his heart. And he's made these full-length productions where he's gone back and actually gotten the data from the Fed information from their meetings, from their FOMC meetings, all that stuff is usually quarantined for 5 years. And then you can go back, sometimes 10. You can go back and then John's done that. And he's found out that go all the way back to 2008 and 9, that Bernanke just flat out lied to Congress in telling them that, oh yeah, and you might remember this, that the Main Street was failing. It wasn't the Wall Street banks. The Main Street was failing and the credit markets were collapsing and all this kind of stuff. And at the time, there was no evidence to show that was happening. What he was simply doing was selling a bill of goods to Congress, whose members are all in the back pockets of the bank because they take their campaign money to get through that TARP plan of $700 billion, right? And so anyway, John has all these great videos that explain that for people if they want to go there and check it out. Anyway, the Fed then, that wasn't good enough. So they started quantitative easing number 1 in March of 2009, and then told us in 2010 that was going to be it. That was just a one-off, right? And the economy, everybody was talking about green shoots everywhere, and the economy was roaring back and all this garbage. And by the second quarter of 2010, that was a little bit true. GDP was growing at a little north of 3%. But then in the third quarter of GDP, it went to 1. Fourth quarter GDP of 2010, GDP went negative.
Right.
In the first quarter of 11, it was negative as well. There you have a recession, 2 negative quarters in a row. And so then in November of 2010, QE2 comes along for another $650 billion. And then in October of 2012, here comes QE3, it was a trillion and all this kind of stuff. So the Fed has told us and lied to everybody for years that interest rates are going to go back to whatever normal is, 5, 6, 7%, for the poor retirees that are trying to live off of, riskless investments like CDs. And they've also told us that this expansion of their holdings, their balance sheet, as they call it, which is the misnomer in its own right, that went from $1 trillion up to $3.7 trillion was somehow going to go back to $1 trillion. What? And here's what we've been trying to tell people for years. Yeah, the Fed could try as part of this charade to raise the Fed funds rate, which is the only rate they can control. And that's exactly what they've done over the last 2 years. They've raised it up to now they effectively call it 2.4%. But see, the rest of the bond market is freely traded around the world. And you can look and go to Switzerland and Germany and all these places in Europe where they're actually a 10-year government bond has a negative rate of return. People are buying it they don't even care that they're not even going to get all their money back. They just know that they're going to get 99% of their money back 10 years from now.
And they're willing to accept a loss.
Right. Just to know the safety. And the reason for that is these central banks, the EU and the ECB and the Bank of Japan and the rest have printed all these trillions and trillions of dollars of currency. So now that money sloshes around the planet constantly looking for a home. So the Fed tries to raise interest rates as part of this charade. But all this money comes flooding back into the US looking for yield.
Right.
And so with all these negative yields now in Europe, it's now flooding in the last 2 weeks. It's been pouring into the US. And so now the 2-year US Treasury note is yielding 1.85%.
So all of that extra cash, Craig, is what's driving our
Exactly.
bond values down and is going to crash the bond market.
Well, it's not a crash the bond market. Bond prices go up when yields go down.
Right.
So all this demand for bonds because they've created it. And so the Fed could raise short rates, but they could never do anything about the long rate. Not only for that reason, but also because the interest on the national debt would explode if all of a sudden it was 6% and not 3%. Consumer debt would explode. The housing market would collapse. Credit card, all that stuff. There's no way they could ever see long-term rates go back to this whatever normal. And by extension, there was no way they could ever normalize their balance sheet either. We've known this. We've been writing about this. My big thesis this year is that 2019 is just like 2010.
Right.
Okay, this whole idea, everything's going to be normal. No. The Fed, we're going into a recession now, and that's becoming abundantly clear. And the Fed is now further trapped because all of that demand for U.S. bonds has done what we call inverted the yield curve, which in layman's terms means that short rates, overnight, 90 days, whatever, should always be lower than long rates, 20 years, 30 years, because banks make interest on they make the spread, all this kind of stuff. That's a healthy thing for the economy. When it inverts, when short rates are higher than long rates, that invariably leads to recession. And now that's what happened. The Fed has hiked short rates so high that now the 2-year is inverted, the 10-year is inverted, even the 20-year Treasury bond is inverted versus overnight. So they painted themselves into a corner. So now to finally get to your answer, John, about what the hell's going on just this week. Well,
right.
Even though I've been talking about this at TF Metals Report for 6 months, the world is finally figuring this out. Wait a second. Hold on just a minute. Fed funds are 0.6% above the 2-year note. That means the Fed, if they just want to get that yield curve back to normal, has to cut the Fed funds rate by 0.75 of a point. Nobody's talking about that. As recently as December, all the fancy highfalutin Wall Street guys were talking about hikes this year.
Right.
So the gold market, the global gold market, if you want to call it that, is now all of a sudden figuring this out. And that's why gold is up. Let's see, as we record here on Tuesday, at one point earlier today, it hit 1349. I'm sorry, Wednesday. One point earlier today, it hit 1349. Last Tuesday, it was 1273. So what's that, $76?
Yeah, it's huge.
It's not going to go straight up. It's pulled back today. Things get a little overbought and you get some profit taking and all that kind of stuff. And the banks that make the markets for the derivatives are going to fight us every inch of the way.
Right.
But this reality now of confidence ebbing in the bankers and them being exposed for the charlatans and the liars that they are, of this magic act that they've tried to shove down everybody's throat for the last 10 years, is now going to cut confidence in the central bankers. It's going to cut confidence in the dollar. And all of this is going to combine to finally really propel gold forward in a way that we've been waiting now for several years. And that's, I'll stop there.
Yeah, that's what's happening. Thank you very much for explaining that. Excellent. Yeah, it seemed like we were stalled. I called it the doldrums between the world is great, the economy is great, it's the greatest economy ever, and when is reality going to set in? And it just seemed like it just started setting in, Craig. Reality, that we're moving into a recession. It's not just China, it's not just the EU, it's the United States. Whether you're talking about the housing, automotive, just the retail sector, everything is kind of like the chickens are coming home to roost, and money makes the world go round. When the money stops, the world stops, and we've got what I like to call shit hitting the fan.
That's right. Where this was predictable, John, is that a lot of the economic growth that came in after Trump was elected was due to business and consumer confidence, that now it's going to be different. They're going to cut taxes. Businesses, had this corporate tax cut rate that allowed them to, buy back their stock for one thing, but also do other things, make forward investments, because now you can do some planning and you can look forward, you can hire some people and all that kind of stuff. What made this predictable, though, was you knew back in 2018 that the Democrats were probably going to at least take control of the House.
And they did.
And if that was the case, not only was all political cooperation going to halt, but then you're going to have all these investigations, endless investigations from endless committees, and confidence was going to fall. And really, what is this if it's not a confidence game? Anybody, even at the individual level, if you're not confident in your future income, you're pretty unwilling to go buy a new refrigerator, that kind of stuff, right? And that's, that's writ large to the whole economy. And so it was really almost inevitable once we got into last fall that the economy was going to begin to roll over. We're seeing it now. The only reason we printed 3% for the GDP in the first quarter is because there was a bogus inflation calculation that allowed it to be 3% instead of 2%. But regardless of that, projections for the second quarter are now closer to 1%. And again, remember how the official definition of inflation works, or recession works. It's 2 consecutive quarters of negative GDP. So think about this. You and I and everybody listening can go, I think we're slipping into recession right now. But that's not going to be a headline until the third quarter GDP comes and goes. And then we get the first guess of the fourth quarter GDP, which won't be till next February.
Right.
Okay, so this is why people need to anticipate. That's what's wonderful about the name of your site, The Prepared Mind. People need to prepare their minds and think outside the box and anticipate where things are going. It's situational awareness, so that you're not, when all this hits the fan, you're not sitting there looking around going, well, I never knew this was not coming. You're prepared ahead of time, and that's what this is for.
That's what we're doing, is we're trying to get out ahead. You need to be prepared: food, water, shelter, clothing. Be a good Boy Scout, in other words. But looking ahead, we're now, I did a couple videos on the crops, the crop reports in the Midwest, corn, all the issues. It's not just about the tortilla chips you're going to be eating for Super Bowl Sunday. It's about all of the cattle feed and how that's going to create other shortages. Can you see that exacerbating the financial news that we'll be receiving in the fall, in the winter, when they finally get around, if they can't kick the can down the road any further, when they announce, hey, we've got a recession here?
Yeah.
Is the news on the crop reports, the agricultural situation, is that going to exacerbate this problem and cause panic?
Panic is hard to foresee. Exacerbate the problem, yes. Okay. These economists that calculate inflation, one of the way they undercalculate, and they do this for a reason, so that cost of living adjustments, particularly on Social Security, aren't sky high, right?
Right.
So it's deliberately misreported and underreported. Okay. But the other thing is, they always calculate, well, there's a substitution effect, right? If beef prices go so high, instead of buying a steak, you buy hamburger, or instead of buying 90% lean hamburger, you buy 80% because it's cheaper. And so therefore, there's no inflation. See, no big deal. And then, in crop terms, there's always kind of a look forward, and, maybe next year will be a lot better. But you're right to point out, I mean, it's the latest crop report from the USDA is terrible in terms of how much they've gotten planted so far and that kind of thing. So panic, I don't know, but it definitely exacerbates the pain for people.
Right.
And as it relates to the regular person, a day is still coming when the demand for dollars, because we printed, with our 22 trillion in deficit and all this kind of, or in debt, and there's dollars all around the planet, and the U.S. has cooked up schemes over the years to maintain and create demand for those dollars, so that they don't just reside here in the U.S. causing rampant inflation. They're parked in central bank reserves, of countries all around the world. Yeah. But when the day comes that there's not that much demand for dollars anymore, which is coming, then all of a sudden, a lot of those dollars come back here, and they've already been printed. And like any other good, for someone that, if you have ever studied economics, you know that there's a supply curve and a demand curve. And where they intersect is your price. Well, if you increase the supply while holding demand constant, or God forbid, even cutting demand, price falls. It reaches a new equilibrium that falls. That's in terms of what that does to the average everyday person. It devalues the currency and makes everything more expensive, makes your savings worth less, and makes everything else more expensive. And for folks that are already strapped, I mean, you've, I'm sure, seen the data, John, of 65% of Americans don't even have $400 saved for an emergency.
That's scary.
What are they going to do when all of a sudden we get into 10% inflation every year? Those, they call them hedonic adjustments, don't work anymore, and that's when things get really unsettled socially, let's say.
Like you, I grew up in the 70s, and I remember dinner table talks with my parents. Inflation going to 10%, 12%, 15%. I'm out here on the West Coast. It was really painful, and people today don't seem to remember that.
No, and I get people, John, that say, well, Paul Volcker back in 1979 and 80 and 81 raised interest rates to 20%, and that
they can't do that.
You can't do that now. Exactly. The federal government, as a line item on the deficit and on the budget, is paying about $450 billion this year on the interest on the accumulated debt, and that's at an average rate of 3%. So at 6%, that's $900 billion just on today's amount. At 9%, or Paul Volcker's 20%, we're talking a couple trillion a year.
Can't even do debt service then, right?
That's more than the total receipts.
Right.
So that's where it gets out, and this gets back to why the Fed could never allow, this idea that rates were ever going to go back up was folly. But, there are not a lot of people with a vested interest in explaining that to people. The media, the politicians, the bankers, they don't have a vested interest in explaining that to people. And so instead you're spoon-fed this story about everything being all right. Just go buy more stocks. Right. And hopefully people are, at least the people you're talking to, are a little more forward thinking.
Yeah, they are. There's a lot of smart people out here, but we're being shoved and hidden away. All the censorship that's going on. It's wonderful. Yeah. They want to keep us like mushrooms, keep us in the dark, sprinkle a little shit on us.
Yep.
My expression, just don't piss down my back and tell me it's raining.
That's what they're doing.
They lie for a living, and that's what they're good at. You said something earlier, and it's actually, I got it on a little notepad here. I wanted to have you attack this. The Federal Reserve, Chairman Powell, he's trapped. He's literally trapped in a corner. He can't go left. He can't go right. If interest rates go up a little, Craig, I'd like you to answer what happens. If they take them down, what does that mean? What is an admission of? And if they can't do any more quantitative tightening, but what happens if they do more quantitative easing? Because, there's a liquidity issue.
Right.
You could address that, what the Fed's options are, and how everyone, if you're not prepared, how you better get used to grabbing your ankles.
Yeah, and don't let me forget to say something about cash, okay, John? Because I'm going to ramble for a second, and I want you to redirect me to that in a second. In terms of, we call him on my site Chief Goon Powell, because of Fed governors, we don't call them governors or commissioners, we call them goons. and he's the chief goon. So Chief Goon Powell is trapped in a sense. Again, for all the reasons we discussed, he can't get rates to go up, and he wouldn't want. I mean, the banks are adjusting the prime rate and stuff off the Fed funds. He wouldn't want short rates to go any farther because you're just killing the consumer and digging the economic hole even deeper. Even though, as I said earlier, he needs to at least cut Fed funds by 50 or 75 basis points right away. He's not going to do it. One, because he didn't want to feel like he's
right. He needs to do that.
He absolutely has to.
From inverting.
And hopefully maybe keep the economy moving along a little bit.
A little bit. And that's kicking the can down the road, right, Craig?
Yeah, in a sense, yeah. But he won't do it. One, because Trump has berated him so much that he'll, he's afraid of making it seem like he's in Trump's back pocket. And plus, he's a pretty cautious guy, at least on the surface. And so he's just not going to do it. And so here's the problem. He may not even, the next Fed meeting concludes 2 weeks from today, Wednesday, the 18th, 19th, whatever the hell it is. Sorry. He should immediately cut at least 25 basis points there, and probably will, even though not a lot of people are expecting it. But here's his problem. If he doesn't, if they just kind of massage the language a little bit and make it sound that like maybe by September a rate cut's on the table, the bond market is going to accelerate and rates are going to accelerate lower because people that invest in bonds will buy a 10-year U.S. Treasury at 2.1% because with no inflation, 2.1% doesn't sound half bad, especially compared to Germany and all that kind of stuff. And the value of the bond itself will go up as rates go down. Because all of a sudden, if rates go to 1%, well, a bond with a coupon of 2%, that's awesome. Okay. So if he does nothing in 2 weeks, this global bond market's going to look at that and go, well, now this economic collapse in the U.S. is now going to be even worse,
right?
And steeper and deeper. So therefore, hell's bells, get me as many bonds as I can get now.
Right.
So say he does 25 basis points, which I'm increasingly starting to think he won't because he's so pragmatic. And if he doesn't, then he's really going to be screwed because the 2-year note's going to go to 1.5. The 10-year note's going to go to 175, and now he's going to have to cut 100 basis points.
Right.
So he's really fine.
He's going to have to go even harder just to catch up with.
Yeah. So he's really in a bind. And then the other thing is, if he starts cutting, that's what I talked about earlier about the ebbing of confidence, because they've told us all along, oh yeah, they're the balance sheet's going to be reduced to normal and rates going to go back normal. Oh, wait a second. As soon as there's a little downtick in the economy, now we're all of a sudden back to cutting rates, go back to zero and QE, and that now to get to that cash point. Yes. The other thing that's coming, and we're already seeing this in Europe, are negative interest rates, not just on government bonds, but stated negative interest rates like fees at a bank. Okay. Right. So right now, anybody listening to you and I, we already don't get any interest. You go open up a money market account or something at your local bank, you get like 0.1%, right?
I got some pennies last year. I got some pennies.
Yeah. You see the sign when you walk in, it says 5-year CD at 0.35%. You're like, what the
fuck? Yeah.
Okay. Yeah. All right. The bank should pay you for holding your money, right?
Right. Yeah.
What's coming in the next downtrend, and again, we're already seeing this, and there are papers being written about how great this is, are negative rates where basically you pay the bank 2% a year, not just, your $5 monthly charge for your checks, but you actually
the inflation loss on your cash.
Right. You're actually paying them to hold it. And this is why, and how you know this is coming is how they are trying to demonize physical currency. And anybody can, if you just start looking for this stuff, you'll see these headlines, you'll see articles in Time Magazine and Forbes and all kinds of places that say the only people that use $100 bills or 100 euro notes or whatever are drug smugglers and bookies and people like that, right? And because they know if you can withdraw money from the bank, because, well, wait a second, you're not going to keep my $100,000 and make me pay you $2,000 a year. Just give me the $100,000.
Right.
And they're going to say, nope, sorry, you can't. Right. And if they've already eliminated physical cash, then you don't have any choice. And when you take money out of the bank, that deleverages the system. It deleverages the money supply. And that's the other thing they cannot have.
They can't tolerate that. That would cause instantaneous problems, wouldn't it?
Exactly.
Even
Exactly.
a bank run?
So what's coming, and I'm not here to give preparation advice, but anybody, if you've got a safe and you've got some physical gold, physical silver, your will, all that kind of stuff in there, there ain't nothing wrong with having, $5,000 in 20s or something stuffed in there as well, because the day is very likely coming. Now, not tomorrow, right? Probably not even a year from now, but the direction where this is all is headed, as these people are desperately trying to keep control and maintain power and everything else, is the complete elimination of cash, right. Making it, against the law to even have it.
Right.
And so that's another critical prepping component, is to have some physical cash too.
You threw Craig, a dollar amount, $5,000. It depends on where you live in the country. 5,000 might last a week, might last you 5 months. Would you put a time frame on that? Have 2 months worth of cash to take care of basic expenses, or 4 months? Can you put a time frame on the?
I don't know. I can't. I mean, I think anybody could probably just make their own decision as to what they think is prudent.
Right. I tell people they're experts in their own world, decide for themselves, but
the other
for your guidance.
Yeah, at least a couple of months. If there's a bank holiday, maybe the first thing that would happen is there'd be like a bank holiday where you can't get money out of the ATMs and stuff, and you got to be able to go put gas in your car,
right?
And buy yourself some food. And to begin with, that'll be, the dollar that does that. But that's also another reason why a lot of people own silver, physical silver. Right. Because even though it's not currently considered a monetary metal, it was more so than gold even.
Right, longer.
And so I think a lot of people, because no one's going to take an ounce of gold and go buy a loaf of bread for it, right? Because it's not fungible is the term that people use. But an ounce or a half ounce of silver under dire circumstances might get you a tank of gas, that kind of stuff. And so that's where, you can, I'm pretty certain that on a dollar basis, you can make some money owning silver in terms of what I mean, buying it for $14 now and selling it and exchanging it back for dollars, which is basically what you do when you sell it, for $50 at some point in the future. If that would float your boat, knock yourself out. But the main reason why you would buy it at $14 now is to hold it for that type of situation. I don't mean to be all apocalyptic and make it sound like, I try to scare people.
Well, but we do that a little here.
Well, it's a mathematical certainty, and I think most people understand that with the debt. It grows so exponentially over time that, and we're now to the point where, it used to be you could go $1 into debt and get $1 worth of GDP growth out of it. Well, now it's like 25 cents.
Right.
Because of the diminishing return of that over time. And so much money is going to just simply the servicing of the existing debt. So as $1 trillion deficits as far as the eye can see, and they're assuming 3% economic growth at that. With all the unfunded liabilities and all the stuff, it's undoubted. You just can't deny that eventually this whole scheme is going to run its course. And that's when there's less demand for the dollar. Somebody else offers an alternative to the dollar. The amount of dollars back home skyrocket. You get massive inflation. I mean, all these things that, again, it's a heavy subject, but for the prepared mind, that person needs to consider this stuff. And what we do at ours, we say prepare accordingly.
Right. Yeah. Well, we've seen between oil, Keynesian economics, everything, the rate of return on the initial investment is dropping over time. So this great term, mathematical certainty, we're heading to that point in time where we go parabolic on debt, on all the problems. They just become a nasty ball, and they're all coming in line. In fact, yesterday, Chief Goon, I'll use your
it sounds good.
He opened his mouth. He ran his soup cooler a little bit. His pie hole was open, and overnight, gold shot up, silver shot up. Yeah. And I'm wondering, are we starting to see some safe haven movement into precious metals, or was this speculators just moving and positioning themselves to make some quick cash today? Or are we really seeing some safe haven movement, which is a recognition that the recession's coming and they're going to start putting themselves in position long term to hold precious metals as the rest of the roller coaster heads for the edge?
There are two questions there. In terms of
Yes.
today, Wednesday, July 5th, what you saw was like a last big shove of speculative money here after 6 days, taking it to where, it was overbought, which is a trading term, which means people are apt to eventually get more sellers and buyers. And hey, I'm going to take my profits. I made $60 an ounce trading these futures contracts, and then it pulls back.
Okay.
So that's that. But on the other part, though, the longer term, the last 6 days, is this awareness of where this is headed. People looking forward and going, oh, wait a second.
Right.
All this is coming, the dollar, and so they start to pray to go in. What the key level that people are going to want to watch, because now we're up here at, let's call it 1340. Gold is priced in a faulty and deliberately fraudulent scheme of these derivative contracts, which are backed by nothing. There's never any actual physical delivery demanded or made. That's just this piece of paper. It's not even a piece of paper. It's a digital whatever. Right. And people buy it and people sell it, and they say that's what gold is. And then the physical market prices off of that. It should be the other way around, but it's set up that way for a reason. And maybe we'll talk about that next time. Moral of the story is price has been held in check as confidence has remained steady in the central bank since 2013. We've been going sideways in about a $200 range for 6 years. In fact, gold has not finished that price of gold that you see go on the screen on CNBC has not finished the week above 1360 since middle of 2013. Okay, so it's been almost.
Craig.
Isn't that crazy? Well, so anyway, so what I'm getting at is if people want something to watch, we get above 1360 some Friday afternoon and then stay above 1360 and start moving higher the next week. That will be a recognized breakout to me, and I mean anybody else that follows it. And there's going to be a huge spike in interest in owning gold in all its forms, because people go, oh, okay, that period's over. Here we go. I better buy. And then it's going to start moving to the upside. It's never going to go straight up. It's always going to be kind of 2 steps forward, 1 step back. But for people that are looking to add some, you might kind of give it a few days to see if it pullbacks here. And then I'd wait to see when price breaks out above 1360, either later this summer or maybe this fall or whenever. And that'll be your clue that we're really cooking, just like we were in 2010.
So when the banker boys, are they going to give up control, or are they going to lose control of the manipulative power?
Right. They're going to lose control. This started out, the whole futures market and all that kind of stuff. And there's a whole long history of price rigging and manipulation by the banks to try to peg price, at the $35 an ounce level after Bretton Woods and all that kind of stuff. So this has been going on for years. Well, the problem is there's not that much physical gold. And demand for physical gold was breaking that peg to the dollar. And that's why Nixon closed the gold window in 1971. And the dollar has just been unbacked by anything ever since. Well, anyway, there's really only so much gold. And so the scheme was cooked up in 1975 to basically do alchemy, to get people to buy futures contracts and options. And then now at a later date, we got the GLD, the ETFs, all this other crap that people accept as gold exposure.
Right.
Okay. Right. Even what would seem to be smart guys like these hedge fund managers, Dalio and the rest, Druckenmiller, they buy the GLD because it's exposure to the gold price, but it's not actually gold. Now, when the time comes that the world demands actual gold again, now we have something, and then that scheme will eventually lead us that way. But in the meantime, it's the demand and the supply by the banks of these derivatives that sets the price. And so when you mention the banks, what the banks are interested in is steady profits. Right. I mean, there are some old-time analysts out there that claim that, JP Morgan has a whole bunch of silver, and so therefore now they're just going to stand by and let price go to 100 and make some massive profit. Anybody that's ever worked with or for a bank knows that that's not how banks operate. Banks want to borrow short and lend long and make the spread every single quarter. Right. Okay? So in silver, for example, JP Morgan, which has a monopolistic position in the pricing scheme, is going to try to keep price under control for their benefit. So where to begin with, it was all set up to manage price for the central banks and all that kind of stuff. The banks themselves, though, now are just greedy. They have monopolistic control of the system, and they are going to keep it. So I believe your question at one point, John, was, will the banks just give up control, or will it be taken from them? They will fight us until the very last trade before the system collapses. Of that you can be certain.
So when gold and silver, they'll probably move together closely. When they break out, that is de facto prima facie evidence that something is wrong.
Yeah.
And we need to pay even closer attention.
Yeah, that would be it. When later this year, when gold is now moving up through 1400 and silver, I don't know when or it'll actually be able to go, but it'll probably tag along too, because there's that substitution effect like we talked about with hamburger. You know, where people say, well, I can't buy gold, but I'll buy silver.
Right.
So it'll go too. But yeah, that'll be a real sign, and which is all part of why the banks will try to prevent it, you know, because if gold's running up to 2000 and beyond, that's a real stab in the back of the dollar. Right. And it really shows that people are losing faith in the central bankers in the system and the dollar system. And so they'll do everything they can to control it. And in the West, we don't want it unless it's going up. Right? Well, I don't want any of that, because all it's done is gone sideways for years. And so a rising price also boosts sentiment, which boosts demand.
Yes.
And that only exacerbates their problem too. So yeah, so the thing to watch, especially when you go into the summertime, is watch that 1360 level. And if we get a sustained breakout through there, price will likely accelerate. And that'll really be telling you that the bankers and everybody else has a big problem on their hands.
Right. Well, I just peeked at my clock. I want to be respectful of your time, Craig. I want to have you back. I don't want you to go, I'm not talking to that fucking John again. All day. You know, I want to have you back as we get into some more interesting times. I'll try and time it where I can get you. But thank you so much for the information. It is stellar for the prepared mind, right? You've got to understand every facet. Without money, the system crumbles, and that's when we see blood in the streets.
Yeah.
If we go that Mad Max direction. I'm hoping shit is the fan light, some sort of gentle reset where we're just sitting in a depression for 10 years.
Right.
You know, that's optimistic, John.
Right.
Anyways, I look forward to all of your information on a daily basis. I value it. And thank you for coming and talking with us and sharing your precious time, Craig.
My pleasure, John. And yeah, let's keep in touch. I think there's kind of more background information too about the history of gold and silver and that kind of thing that people probably want to hear. So yeah, by all means, let's keep in touch. And thanks again for the chance to get caught up and get acquainted.
Yes, sir. Thank you so much, Craig. Have a great day, great night, and don't lose any sleep, huh?
Yeah, I'll try.
Thank you, sir.